Studies show that the wealthiest people in the world don't avoid debt, they embrace it. By leveraging borrowed money, they unlock opportunities for massive financial growth. Keep watching as I am going to show you the 6 ways rich people use debt to make money, and learn how you can leverage debt to your advantage. Number 6. Real estate investments. One of the key strategies the wealthy use to build their fortunes is investing in real estate through mortgages. By taking out loans to purchase properties, they can own valuable assets without paying the full price up front. This allows them to use their cash for other investments or opportunities, creating a diversified portfolio. Rich individuals often leverage property appreciation and rental income to maximize their returns. When they buy a property, they aim for locations with potential for value growth. Over time, as the property appreciates, its worth increases, leading to significant profits when they decide to sell. Additionally, renting out these properties generates a steady income stream, covering mortgage payments and sometimes even providing extra profit. For example, imagine purchasing a $250,000 property with a $200,000 mortgage. By renting it out, the monthly rental income might cover the mortgage payments, property taxes, and maintenance costs, while still leaving some profit. Over the years, as the property's value rises, the owner's equity in the property grows significantly. This combination of rental income and appreciation helps to build substantial wealth over time. The concept of good debt is crucial here. Unlike bad debt, which drains finances, good debt like mortgages can be beneficial when managed wisely. Low-interest mortgages, in particular, offer a cost-effective way to invest in real estate, with interest rates often being lower than the potential returns from property appreciation and rental income. The overall profits can be substantial. By strategically using mortgages to buy real estate, the rich can effectively increase their wealth, leveraging other people's money to achieve their financial goals. Number 5. Business expansion. Another method the wealthy use to increase their wealth is through business expansion, financed by debt. Entrepreneurs often rely on loans to grow their businesses, allowing them to seize opportunities that would be out of reach if they only use their own money. By borrowing strategically, they can scale their operations and boost profitability. Business loans are frequently used to purchase additional inventory, open new locations, or fund marketing campaigns. These investments can lead to increased sales and market presence, ultimately generating higher revenues. For instance, consider a successful restaurant chain that decides to take out a $500,000 loan to open new branches. With this expansion, the business can reach more customers, increase its market share, and significantly boost its income. The use of debt for business growth is not without its risks, but with a solid business plan, these risks can be managed. A detailed plan outlines how the borrowed funds will be used, expected costs, and projected revenues. This helps in understanding the potential return on investment, ROI, and ensures that the loan will contribute to the company's success rather than becoming a financial burden. Moreover, the projected ROI is a critical factor when considering a business loan. Entrepreneurs need to ensure that the returns from their investments will exceed the cost of the loan, including interest. If done correctly, the additional revenue generated from the expansion can easily cover the loan repayments and still leave a significant profit. Number 4. Stock market leverage. Wealthy individuals often take advantage of stock market leverage to amplify their investment returns. By using margin loans, they borrow money to buy more stocks than they could with their own funds alone. This approach allows them to potentially earn higher profits, but it also comes with increased risks. When investing with margin loans, the idea is to use borrowed money to buy stocks that are expected to perform well. This can lead to significant gains if the stocks increase in value. For example, an investor might use $50,000 of their own money and borrow another $50,000 on margin to purchase $100,000 worth of high-performing stocks. If these stocks appreciate by 20%, the total investment grows to $120,000, resulting in a substantial profit after repaying the borrowed amount. However, leveraging stocks through margin loans is not without its dangers. While the potential for higher returns is appealing, it also means that losses can be magnified. If the value of the stocks decreases, the investor not only loses their own money, but also still has to repay the borrowed funds. This makes understanding market trends and having a solid risk management strategy crucial. It's essential for investors using margin loans to closely monitor their investments and set up safeguards, such as stop-loss orders, to limit potential losses. They also need to stay informed about market conditions and trends to make educated decisions about when to buy or sell stocks. Number 3. Buying cash-flowing assets. Rich individuals often invest in cash-flowing assets to generate regular income. These assets can include rental properties or dividend-paying stocks, which provide a steady stream of money over time. By acquiring such assets, they can ensure a continuous flow of income that helps cover any debt payments and still leaves room for profit. For instance, when purchasing a rental property, they might take out a loan to finance the purchase. The rental income from tenants can then be used to pay the mortgage, property taxes, and maintenance costs. Ideally, the rental income exceeds these expenses, resulting in positive cash flow. This means that after all the payments are made, there's still profit left over, which can be reinvested or used for other financial needs. It's crucial to choose assets that offer reliable and consistent income streams. Not all rental properties or stocks provide the same level of financial security. Properties in high-demand areas or stocks from well-established companies with a history of paying dividends are generally safer bets. This reliability ensures that the income generated will be sufficient to cover debt obligations and generate profit. Selecting the right cash-flowing assets can significantly boost one's financial stability and growth. By using loans to acquire these income-generating investments, wealthy individuals can leverage debt to build a robust financial portfolio. This strategy allows them to maintain a steady income while also paying off their debts, illustrating how debt can be used effectively to enhance wealth. Number 2. Tax benefits. One lesser-known advantage of using debt is the potential tax benefits. In many cases, the interest payments on certain types of debt can be tax-deductible, which effectively lowers the amount of taxable income. For example, mortgage interest deductions are a common benefit. Homeowners can deduct the interest paid on their mortgage from their taxable income, reducing their overall tax liability. This means that instead of paying taxes on the full amount of their earnings, they can subtract the interest payments, leading to a smaller tax bill. Wealthy individuals often use debt strategically to take advantage of these tax benefits. By structuring their finances to include tax-deductible interest payments, they can significantly reduce their taxable income. This not only lowers the amount they owe in taxes, but also allows them to reinvest the saved money into other profitable ventures. It's crucial for those leveraging debt for tax benefits to consult with tax professionals. Tax laws can be complex and subject to change, so expert advice ensures that they are maximizing their benefits while staying compliant with regulations. A good tax advisor can help identify all possible deductions and create a strategy that minimizes tax liability. Number 1. Leveraging other people's money. Another powerful strategy used by the wealthy is leveraging other people's money through investor capital or partnerships. By bringing in outside investors to fund their ventures, they can significantly reduce their own financial risk while still enjoying substantial returns. For instance, consider a scenario where several investors pool their resources to purchase a commercial property. Instead of one person shouldering the entire cost and risk, the financial burden is shared among all investors. This collective approach not only minimizes the risk for each individual, but also allows them to undertake larger and potentially more profitable projects than they could on their own. Using other people's money effectively requires building trust and presenting solid investment opportunities. Wealthy individuals often attract partners by demonstrating a clear and promising plan for profitability. They provide detailed projections, market analysis, and risk assessments to show potential investors that their money will be well managed and likely yield good returns. It's essential to foster strong relationships and maintain transparent communication with all partners. Trust is the foundation of these arrangements, and it's built through consistent performance and reliability. When investors see that their funds are being handled responsibly and are generating the expected returns, they are more likely to continue investing in future projects. Leveraging other people's money allows the wealthy to minimize personal financial risk and maximize potential returns. By forming partnerships and attracting investor capital, they can access more significant opportunities and build wealth more effectively. This approach highlights the importance of trust and presenting viable investment plans to secure and maintain investor support. We hope you enjoyed learning about how the wealthy use debt to their advantage. Share your thoughts and any other strategies you know in the comments. Remember to like this video, subscribe to our channel, and click the bell icon for more financial tips.